Good morning, everyone, and welcome to Exchange, the first ever retail investor conference from Public. Throughout the day, we'll be speaking with an incredible lineup of leaders and experts from across the business, finance, politics, and worlds of culture, all with the goal of giving you access to insights to navigate the current investing landscape and make more informed investing decisions. I'm Anne Berry, and I'll be kicking off our first fireside chat of the day with Cathie Wood, who is founder, CEO, and Chief Investment Officer at ARK Invest, an investment management firm focusing on disruptive innovation. We're going to be chatting this morning about the macroeconomic outlook, the state of crypto, and Cathie's point of view on headline-grabbing industries like electric vehicles and artificial intelligence. It's fantastic to have you, Cathie, here. Welcome to Exchange. So few people have captured the imagination of the retail investor as successfully and at such scale as you have, particularly over the last couple of years. And it's that catchphrase, disruptive innovation, that really defines ARK, Cathie. When you unpack that, what does disruptive innovation mean for your investing?
Okay, well, I think this is a really important question, Anne, in terms of helping your viewers understand what truly disruptive innovation is. We're very specific about this. It meets three characteristics. The first is a learning curve, so technologically enabled innovation, a learning curve characterized by cost declines that open up mass market opportunities. The second is that the innovation, we must see that it can cross economic sectors. That is the way it will become a mass market opportunity. And then the third is these platforms serve as launching pads for more innovation. So a good example of that is if DNA sequencing didn't exist, then nor would gene editing. And gene editing promises to cure disease.
And Cathie, when I look at this suite of ARK products, if you go to the website, you can see there's a genomics ETF that you've got others that are autonomous vehicle specific. But you look in the flagship ARK Innovation ETF, one of your biggest holdings is Zoom, for example. You can see how that matches that first point, which is scaling, crossing across different economic swathes, bringing down cost over time. But in terms of continuous innovation, for a company like Zoom, how does that fit the definition? Some people would say it was a work from home stock, it's over, but there it is in your ETF. Walk us through that rationale.
Yes, I think what many people think about Zoom is incorrect. And I understand why it is. We all used it during COVID, and that's what we think it is. But we believe that for the first time since the early 90s, the enterprise communications, which is the largest part of the tech stack, is going to go through a rip and replace cycle. Okay, so if you think about the early days of the internet, a lot of it was Cisco building out the backbone. So it was hardware centric and it was on-prem. Zoom and Microsoft are taking that world into the cloud. So, and that's what I think people are missing here. The enterprise communication space is a $1.3 trillion revenue space per year. And we think that backbone is going into the cloud, and two companies will share it. I think that's highly misunderstood. I think it's almost 60% of Zoom's revenue is enterprise revenue. And then one of the things that they're introducing, and this will be a familiar refrain with all of our stocks. They are starting to leverage AI, artificial intelligence, because they're collecting all of this amazing information from videos and chats and so forth. And they're going to be able to deliver new products powered by AI that others are not. And one of those is for sales forces. They have a partnership with Salesforce. We know Salesforce is striking lots of partnerships, but this is a deep partnership. And I think they're going to leverage AI and take it into another orbit.
Let's talk a little bit more about AI, Cathie, because it feels as though every .com wants to change its domain to sort of .ai, right? It's really just become, it feels like the new buzzword for 2023. You've described businesses that you think will win in AI. What are some of the areas you think, it's hype, we've just got to wait and see, we're not going in there yet at ARC?
Well, we're delighted that ChatGPT has captured the imagination of consumers and businesses. And it is really remarkable. It involves breakthroughs that if you had asked us 5 years ago, we would tell you we might see them in 2030. So this is prime time. This is prime time. Unlike the tech and telecom bubble, which a lot of people remember, and because of that, they're scared of our kinds of strategies. The problem with those strategies back then is the technologies weren't ready and the costs were way too high. The technology, AI, large language models, machine learning, whatever you want to call it, predictive AI, generative AI. There are lots of buzzwords around it, but generative AI, is the wave of the future, and it's here. It's here. ChatGPT proves that out. And so I think what's happening this time, unlike the tech and telecom bubble, is the technology is moving even faster than we thought it was. And this is all we do. And we think that AI, you might say it's overhyped, and I think I would mistrust anyone who decides to put AI inside their name, just the way these things go. Let's put it this way, I'd research them very carefully. But we do think it's going to be explosive because the costs associated with AI are dropping 70% per year. And we think it is going to be the most profound innovation that is going to actually enhance each of the other platforms. In other words, there's a convergence between and among technologies, and AI is the biggest part of this.
Cathie, I do want to make sure the public community gets the benefit of your perspective on the macros, just to sort of lead into that. When you think about the applications of AI in the way that you've described, how do you feel about the outlook for the labour market? Do you think this is the path towards mass unemployment, or do you think that this is a path towards just greater productivity?
Well, we think that technology net is a job creator, net. Think about of all the jobs created as we automated the farm, right? Think about how much the world has changed. And in fact, in the early 1900s, people were worried that tractors were going to throw people out of work. Well, much of this labor was free. It was children. Families were running these farms, and the children were working for free. This opened up those children to leave the farm and become a part of the Industrial Revolution. Now, with robotics and artificial intelligence, we're going to see manual, and some people would say menial labor, converted into much better jobs. Now, is there some displacement in the short term? Yes. And we believe that corporations and schools are going to have to retrain people as these technologies evolve. But, there's a lot of do-it-yourself learning. This is a completely new area, and you can get on the right side of change and ride some exponential growth curve. So I think it's a very exciting time for people who want to move onto the right side of change, want to, harness incredible opportunities being created by technology. I think it's going to be the most fertile time for people to determine their own success by embracing and learning and becoming a voracious learner about these new technologies.
We'll have to get you back, Cathie, to talk about that, because one of the areas that AI has been posed as perhaps a threat, perhaps just a new building block, is education. And what does that mean for teachers? What does that mean for the way people can go in and get the new skills that you've described? when you look at what has happened with Bitcoin, down about 30% over the past year. If you look at 2023, it's sort of done the bookends. If we've seen FTX, and that has sort of come to represent sort of the worst of what can happen in crypto. If you look at what's happening right now in this incredibly volatile macro, we've seen Bitcoin bounce a little back up recently because there's a whole narrative around it being a safe haven asset or the modern gold. So sort of two bookends in such a short space of time already year to date. Where are you on this, Cathie? Where are you on the outlook for Bitcoin?
Well, we can close the loop on what you just said. Last year was a terrible year for crypto. But why was it such a bad year? The first reason was algorithmic stable coins. We didn't believe in those at all. They weren't rules based. And so that was the Terra Luna fiasco. So you have to do your research in this space and not try to ride a dream of some sorts. But then if you look at Celsius, 3AC, FTX, all of them went bankrupt. Why? Why? They were centralized and opaque, not transparent at all. In fact, Sam Bankman-Fried, so SBF, as everyone came to know him, he didn't even like Bitcoin. He didn't like Bitcoin. Why not? Bitcoin is totally decentralized, completely transparent, and auditable. He couldn't control it. He couldn't control it. And of course, he thought he was a master of the universe. So Bitcoin actually, and Ether, neither Bitcoin nor Ethereum, those two networks skipped a beat throughout all of those controversies. All of the transactions cleared, all of the margin calls that were a part of smart contracts, they were satisfied. So actually those crises proved the concept. Now we come to the banking crisis this year. Just think about what a proof of concept this is. The decentralized, transparent, audible networks didn't skip a beat. And here we had, stocks halted in the stock market, in the regional banking space, because there were bank runs taking place. That of course was not happening on these decentralized networks. And so I think that, as you say, digital gold has now gained even more credibility. It came out of the last crisis, the 08-09 crisis is when Bitcoin emerged. And it took another crisis for others to understand, oh, wow, maybe our banking system isn't as safe as I thought it was. And maybe I need a hedge against that. Bitcoin is a very good hedge. It's a great insurance policy.
Cathie, can I just push you a little bit on something you said there with respect to Bitcoin? You pointed to the analog of the current banking system. And we saw a bank run on Silicon Valley Bank. We saw deposit withdrawals from First Republic because there was a crisis of confidence, because there was a herd mentality and then a herd rush that impacted those financial institutions. We have seen with Bitcoin, we have seen with crypto, confidence rupture at points over the last 24 months. And as a result, the price come down dramatically. So even though it's decentralized, do you think it's still immune from animal spirits?
I think it is an anti-fragile asset, and every one of these crises strengthens it. The network becomes stronger and healthier, and we have metrics to manage that. The price is extremely volatile, as is the case with most innovations and new technologies in their early days. There's a lot of uncertainty. Why? And this is a perfect example. There's the old guard, and they're trying to say, we're going to wipe this innovation off the face of the earth. It has no reason to exist. And the innovation just gets stronger and stronger and stronger with time. And if you look at the measurements of the health of the network, the Bitcoin network, the Ethereum network, their health has actually improved through all of this turmoil. So that's essentially what I would say. And we think that crypto is three revolutions in one. One is the money revolution, which is what we're talking about here when we talk about Bitcoin. And that could be the biggest of the revolutions. The first global private, no government interference, a digital rules-based monetary policy with no central point of failure. Who knew Silicon Valley Bank was going to be a central point of failure? Nobody. It's shocking. But I will tell you, just in terms of setting this up a bit, the second revolution, let me do this first. Second revolution is a financial services revolution. And that's called DeFi. Many people call it DeFi. Ethereum is the network most used for this. Chris Berniski, who was our first analyst, would like to name it the Internet Financial Services Revolution. That way more people will understand it. DeFi sounds gimmicky, and I agree that might be so. But we do think that it's going to revolutionize financial services and collapse the cost. And then the third revolution, Web3, metaverse, is effectively, for the first time, digital property rights. That's a big idea too. So we think that crypto, the entire ecosystem, is going to appreciate from $1 trillion today, and Bitcoin's just a little less than half of that, to $25 trillion by 2030. These are very big ideas. Now, to get to the economics part of this, the reason we're going through this crisis is two serious mistaken assumptions that banks and bank examiners have made, and also that the Fed has made. The first is that interest rates, after we went through COVID and we were worrying about a depression, banks said they were flooded with cash from the stimulus programs. And so banks put it to work in long-term interest rates, which at the time were only really 1.5%, because they thought the economy was going to be shut down for a very long time. And the Fed told them that it thought that the economy was going to be down and out for quite a while. So they put money into securities at 1.5%, and never dreaming that the Fed would raise interest rates by 19-fold in 1 year. Well, that happened. That has never happened in history. In fact, the biggest increase that we have seen in a short period of time was twofold back in the early 80s under Fed Chairman Volcker, when he was trying to strangle inflation. But 19-fold, this is, a magnitude earthquake we have never seen in the financial system.
Cathie, one of the reasons that has happened, at least the Fed would say, is that they have been data-driven in their decision-making, and the data has been very mixed at times. It has been adjusted in some cases. When you've talked about disruptive innovations, you've said that this can complicate the meaning of economic statistics, right? The data
Yes.
can be open to different interpretations. Can you just expand on why that is when you've got the pace of change we're describing?
Sure. So, yes, the economic measures that the Fed is basing its policies on are old. They're based in the industrial age, and they get revised in major ways as technology begins to inform them that, wait a minute, we're not measuring this correctly. And so we think they've been relying on lagging indicators, huge lagging indicators, and ignoring the data. And I'll give you the data, and then I'll tell you the second mistake that was made. The data was in spring of 2022, credit default swaps on banks in the banking system started moving up, and they kept moving up all year. The Fed ignored that. That was starting in January of last year and intensifying through the spring and lasted through most of last year. The second thing they ignored was a yield curve, which inverted in July. An inversion of the yield curve. And so to explain that, typically long rates are above short rates. July of last year, long rates fell below short rates. That is a signal to the Fed that the economy is either going to slow down rapidly and end up in recession, or that inflation is going to be much lower than expected, or both. They ignored that. I wrote a letter, an open letter to the Fed last year in October saying, respectfully, I don't understand why you are raising interest rates by 75 basis points at a clip when we've got conflicting evidence and you're voting unanimously. What about credit default swaps? What about the inverted yield curve? What about commodity prices coming down? Oil price peaked last March, April at $130. By the end of the year, it was near $70. The Fed ignored that. And it ignored what companies were saying as they were reporting earnings. So they ignored so many things. So I fault them very directly. And the other thing, the other mistake people made, regulators fed everyone, was never dreaming that deposits would leave the banking system. We have not had a decline in money growth on a year-over-year basis since the Great Depression of the 1930s. Money growth is negative year over year right now. And we just got the answer of what that was going to break. It was going to break the banking system because deposits were leaving for higher yielding money market funds. Banks were stuck with these low yielding securities and just could not raise their deposit rates that much. And so deposits left. And so, real problem, the Fed usually responds to interest rates. It's taken them a while to respond to the long-term interest rate. The 10-year Treasury yield peaked last October at 4.3%, and still the Fed's raising rates.
Cathie, last question for you, which is related to the way in which you and the team do your analysis. ARC is famous for not necessarily recruiting folks from traditional finance backgrounds. Can you talk a little bit about how you hire and what you look at skill set wise when you're building your team out at ARC?
Sure. We are looking for individuals with domain expertise in these technologies. So I described 5 platforms. They involve 14 different technologies. So the way we've set up our research department is very different from the traditional research department. Traditional research, in traditional research, responsibilities are broken out by sector or sub-industry or sub-industry. In fact, many firms are proud of how many sub-industry experts they have. We have not set ours up that way. Our analyst responsibilities are broken out by technology, and they are technology experts, and they become generalists when it comes to sectors, because as I mentioned before, we think these technologies are going to span across sectors. So we feel it's very important to have domain expertise. And I'm taking a leaf from a person called Sandy Bernstein, who founded Sanford C. Bernstein.
Sure. Yeah.
He said he used to hire by domain expertise. And the way he described it, and I'll update it, was it is much easier to train a biochemical engineer how to read financial statements and put them together than it is to teach an MBA biochemistry, right? But if you look at the analysts out in the traditional world, most of them, maybe except in the healthcare sector, but most of them are MBAs. And it gives you a good idea of why they got Tesla so wrong. They defined it in terms of the old world, an auto company. It's not an auto company. It's an AI company, battery company, software as a service company, energy storage company. It's 4. And we have 3 analysts focused on that model. And they're experts in each of those areas. They collaborate to put the models together. That would not happen in the traditional world. In fact, if a technology analyst wanted to take Tesla in the old world, there would be turf warfare.
Right. Well, maybe at some point, Cathie, AI displaces us all. So we will have to wait and see. That is Cathie Wood, everyone, founder, Chief Executive Officer, and Chief Investment Officer at ARK Invest. Cathie, thank you very much for your time and for joining us this morning. Coming up, folks, in just a few minutes, Georgetown law professor Chris Brummer joins to discuss FinTech's next chapter. Stay tuned.